This podcast is for informational purposes only. Please speak to a qualified tax professional about your specific circumstances before acting upon any of the information provided.
So hello and welcome to episode 2 of Crypto Tax Sucks. This episode is all about DeFi, and we're getting into the weeds of why DeFi taxation is really difficult. In the first episode, we kind of covered off the basics of cryptocurrency taxes, and we got the perspective from Louise Lane of Wright Vigar Accountants and Jeff Hancock of why crypto tax sucks. We talked about why it's difficult for people that are on PAYE to understand that they actually have to pay tax on the crypto in the first place. And we got your questions answered on how to handle the tax treatment if you've got assets stuck on like FTX, Voyager, Celsius, BlockFi. And we also did some commentary as well on staking rewards. So as I mentioned, this one is more about DeFi. We're going to talk about lending, staking, liquidity pools, and I've got some really great guests today. So I'm joined by Joe David, who's CEO and co-founder of MYNA Accountants, a crypto specialist accountancy firm. And we've also got Tom Wardle, who's COO of Swapsicle, which is a DEX on the Avalanche blockchain. So how are you both?
I'm great, thank you.
Good. How are you?
Yeah, I'm good. So I'm gonna start off, guys. I love asking this question to accountants because accountants typically, you have to put on this kind of like professional persona. Maybe not for you guys because you guys are into crypto and you're supporting all the crypto bros. But I'm going to ask you, why does crypto tax suck? And should we start off with you, Joe?
Yeah, I think because we've obviously seen the title of what you want to talk about, so I've had to think about what my answer to this would be, and I think I could be here for a while, but I think for me it's the and we've talked about this, Dan, lots of times in terms of HMRC and regulators and rulemakers understanding the underlying transactions that are occurring, and I think that the main reason why it sucks is because that isn't happening, and there aren't HMRC people, for example, or regulators talking to companies like Swapsicle, which are a decentralized exchange, exactly what we're talking about here, and understanding the fundamentals of what's happening. So I think if somebody was to do that, I think we would get a much better approach. But unfortunately, people aren't doing that. So that's the main reason, I would say.
Okay, cool. Yeah, I mean, it's an early market, right? And it's a new technology. This is when we need to be like collaborating. And I know some of the frustrations, just so the audience know, we're co-chairs of the DeFi tax working group at Crypto UK. And I know there's been a lot of frustration with Crypto UK in that, there was new guidance released around DeFi in February and there was no consultation, there was no discussion. It was just released. And I know that HMRC, they've had some legal analysis and they felt the need to, put that guidance out there. But it would have been good to have kind of like a bit of a head start on that to understand the rationale behind it all before just having that launched on you just after tax season when you've probably just filed, or maybe you were filing late and then you've got to kind of take all this on to work out what you need to do.
Yeah, because they gave an extension as well this year. So February was possible to be filing. So, we did have people, and this is the challenge as an accountant and a tax advisory firm, if you like, that we had, was that we'd filed a load of returns up to the 31st of Jan. Then we got new guidance. When did it come out? 1st of Feb or 2nd of Feb or something like that?
Something like
it was
that.
Along those dates, wasn't it?
Yeah.
Yeah, and then we had to file, in theory, we then had to file different information for people after that, but also some people we'd already started but hadn't finished, so it was crossing. Do you know what I mean? It was a nightmare. So I think a little bit more foresight on that would have been a bit more beneficial.
Tom, what do you think? Why does crypto tax suck from your perspective? And it's going to be interesting from your side because you're an accountant and you're obviously COO of Swapsicle, so it'd be interesting to get your perspective from both sides.
Yeah, I think it's very much along the same kind of lines as you guys, to be honest. as you were saying, with the guidelines being, released without any prior consultation, a lot of the guidelines are very open to interpretation. There's a lot of different ways that people could take it. And again, like you say, me being from DeFi, there are so many new and intricate ways of DeFi being released all the time. So there is no way that these guidelines are going to constantly be up to date with the constant shift and momentum of this industry. So yeah, I do agree that, there does need to be, these workshops obviously are really starting to help, but getting there along the line to make sure that, there's a clear path for everyone to follow, really, because, there's millions of different products out there now, millions of different tokens, and, it's just going to get more and more complicated. So yeah, hopefully we get there.
Cool. Yeah. I mean, for me, the main sticking point for the new guidance is this concept of when things change beneficial owner. And it's like, what asset test do you put in place to know when that happens, right? And there doesn't seem to be any kind of any rationale behind that to decide, black and white when there is a change of beneficial owner. So, we've mentioned that we're going to cover off things like staking, liquidity pools, lending, loaning. When you kind of participate in those activities, and the counterparty, it could be a smart contract, it could be a person, it could be an exchange. It just seems that there's like a blanket approach that is a change of beneficial owner, and doesn't actually look at who controls the assets or what controls are in place where you might actually retain some kind of ownership. Don't know what you guys think of that.
So just to jump in, on that, Dan. So I had a conversation with someone, I won't name who they are on here, but and their view was that, and they, I won't say too much because it'll probably give away who it is, but their view was if the beneficial ownership doesn't change, so take Swapsicle for example. I spoke to our CTO at Swapsicle and said, if somebody stakes their funds on our platform, like effectively, do we have access to, let's take FTX as an example, right? If it clearly, based on this morning's news that that SBF was arrested, clearly they believe that assets were stolen, if you like. Do you know what I mean? They were used for purposes that they weren't allowed to be used for, right? In the DeFi world, though, that in some cases, and Swapsicle is a perfect example, that doesn't happen. We can't, unless we steal. I say it can't happen. Obviously, we can steal people's funds, right? Obviously, we could do that. That's anybody can do that in the world. But what we can't do is use those funds in a way that the terms and conditions don't allow us to, if that makes sense, because it's all held under a smart contract. So somebody would have to kind of break the smart contracts, as it were, to then steal those funds, rather than them just being deposited in a bank account or a custodial account that then somebody can just go and pick some money out of and use. Does that make sense? I don't know if I explained that very well. But so my point is, the terms and conditions of Swapsicle, for example, would mean, in theory, that there is no change of beneficial ownership because we are not able to access those funds. We're not able to use those funds. We're not able to do anything with those funds. They're simply being held effectively in like escrow in a smart contract on behalf of the people. So that person then said to me, well, if that's the case, and that's what the terms and conditions say, there is no change of beneficial ownership, and therefore you don't have to apply the guidance. The problem with that is, and you're a software guy, right? So the problem with that is, that's all very well and good, but how does this piece of software fix that problem? Because you can't go, oh, for this exchange it does this, for that exchange it does that, because there's millions of exchanges out there. So then you've got to go down the blanket rule approach, and the blanket rule approach is either it's disposal or it's not. So I think I understand what they're saying in that, well, if it doesn't apply, don't apply it. That's fine, but that doesn't help the mass market. Do you know what I mean? That doesn't help automate and speed up the process of the administration of doing your tax return or reconciling your accounts, because it's could potentially be a different rule for every exchange. If that made any sense, it's a bit garbled.
No, that makes a lot of sense. I thought it was quite interesting what you said about terms of service. So FTX's terms of service said that you retained like the legal title to your assets and that they were yours. So then, if we've got HMRC looking at terms of service to decipher if there's like a change of beneficial owner, well, those terms of service might be contradictory to the actual facts what have actually happened with your assets. FTX say that I've got a Bitcoin on the exchange, but there was no Bitcoin, right? So then it's then how do you then throw this into the mix as well of deciding if there's a change of beneficial owner? And your point on smart contracts as well. You could code a smart contract in an unlimited set of combinations, and it's going to be really difficult to determine what the hallmarks are of a change of beneficial owner. Like you say, you think that the smart contract on Swapsicle acts as an escrow. HMRC's kind of approach on that might be that they see the smart contract itself as its own beneficial owner. So it's trying to come up with that rule set and that level playing field. And I think they did kind of address some of this in the call for evidence that they put out in the summer. And to be fair, what they're striving towards in that call for evidence does seem very sensible, but we kind of haven't seen any movement on it as yet. Don't know when it's dropping.
No, and I think yes, and I think that there's an issue, or if you like, what FTX did was clearly against their terms of service, right? So they, that was clearly fraud, clearly theft, and they're clearly was something very different. And I guess what I'm talking about here is the difference, and this is why I say like what happened with FTX wasn't crypto's problem. What happened with FTX was a fraudulent person or group of people that decided to do something that wasn't allowed. That's not, in fact, with Swapsicle, in principle, crypto solves that problem because we can't do it. And I keep saying we, people probably don't know, but I'm CFO for Swapsicle as well. So we can't take that money. Like we physically can't do it. It's not there. It's not in a pot for us to take. The only way we could do it, like I say, is if we stole it or altered the smart contract in some way or what have you. So I think there's also a big difference there. Do you know what I mean? Between what can be done in the kind of centralized world and what can't be done in the decentralized world. And that, I think, is really important for HMRC to look at, to understand, and lawmakers to say, well, hang on a second, let's think about this. If we don't have a centralized third party, there can't be a rogue person, and therefore the rules have to be different for centralized to decentralized. Do you see what I mean?
Yeah, I get you. Yeah, I mean, HMRC can read over FTX's terms of service, Celsius's terms of service. You can make a determination if there has been a change of beneficial owner. But what's going to be really difficult is you're going to actually have to read the code for all of these different smart contracts, all these decentralized platforms. And then you're going to have to make a judgment of how you've interpreted the code if there is a change of beneficial owner. So again, this is probably all solved by, the call for evidence that they put out in the summer. Whether or not we'll see any impact from that call for evidence, I don't know. Things have gone very quiet, but we kind of put our case together at Crypto UK, right? There was 3 options of how we can create a carve out for this scenario. And, with stocks and shares, they have carve outs. There's the repo rules. If you're lending your stocks and shares out, you pay no tax. We want those kind of carve outs for crypto. And it did seem that HMRC were kind of warm to that. So maybe we will see change. Maybe this problem will go away. But I'm sure there's going to be another problem that jumps in just because the pace of the market and the innovation, it's just so hard to keep up, right?
But that's the thing, isn't it? It changes every day. I'd be interested, Tom, on your side, like as a taxpayer as well, right? Because you've been in DeFi, so how do you perceive it from a taxpayer's perspective as well?
Sorry, in terms of the ownership question?
Well, how do you feel like when you're like as a taxpayer, but also an accountant, but also someone working in DeFi? Like, how do you see all of this change of beneficial ownership, and like, where's your views on it?
Yeah, I mean, obviously, with the whole decentralized aspect, obviously, as we said, the whole point of the decentralized nature is so that you are always in control of your funds. So there is no third party, there is nobody there to access those funds, only you can. That's why I love what Swapsicle do. That's why I love the smart contracts that have been built. You can verify everything all directly on the block scanners. You can see this is the smart contract. This is where the funds have been deposited. you can, as you said, you can see the code, you can check who has access to it, and that's why we have all of these audits done as well, to make sure that these smart contracts are airtight. Nobody else can access them other than the user. And I think that's such a crucial point in terms of, has the ownership really transferred? Not really. I can still access it. I can draw it out whenever I want. There are DeFi products out there which have penalties on them and other sorts of things, but you're entering into that with your permission as such, and you can take it out with your permission. So it's an interesting topic for sure, but I do think it needs a bit of work.
I mean, do you think the crypto world's going to go full decentralized now we've had these collapses of, I can't even recall how many companies are in Chapter 11 at the minute. It's Celsius, BlockFi, Voyager, FTX. There's probably like 3 or 4 more to come, right? So is this the push that everybody needs to go fully decentralized?
I think in terms decentralized in nature, in terms of the way the current laws and regulations are, I don't think a fully decentralized environment could work, purely just for disclosure reasons. What everybody needs to know. Obviously, in terms of avoiding, like an FTX situation, yes, it's shown that it's very crucial and that we do need these setups. However, I think we'll probably come to a conclusion of more of a hybrid model. Because you could go through a full DAO structure, be completely decentralized, operated by a community of anonymous people. That's great, but are you going to be able to report and regulate these kinds of structures? Probably not. So you need to kind of make it so that you have a core set, kind of what we're doing at Swapsicle. We have a core centralized team. We have a board which all the decisions pass through that. However, obviously, all of the users are still in there, still own their funds. They can still make all their decisions. They can give input as to how proposals that go forward, but it's still run by a core team. So I think we just need to try and find that happy medium, really, as to we can't control users' funds, so therefore the users are always in control. But at the same time, there is a team running the platform to ensure that it stays stable. So you've got to kind of find that middle ground.
Okay. Yeah, I mean, it seems to me that like the centralized exchanges, they're not going to go away, right? Everybody wants that kind of easy on ramp, but maybe we could use, a lot of the exchanges, right, are doing like proof of funds and cryptographic techniques to confirm where assets are and how they're held. I think bringing that kind of technology into centralized exchanges is important, and I think a lot of the good exchanges have been doing that anyway. It's the whole kind of verify, don't trust argument, isn't it? You don't have to trust with the whole decentralized world.
And that's the big thing, isn't it? What's people's biggest issue with FTX? The biggest issue is that they trusted a third party with their money, and lo and behold, someone said to me this morning, I had a meeting this morning, and he said, humans are made to, and hopefully you don't mind me swearing on this, to fuck over other humans. Like that's what he said to me, and I'm not saying that is everybody, but ultimately as humans, we've got that competitive edge or whatever it is. We've got that desire to want more. We've got that, and sometimes that pushes it over the line. So as humans, we have that in us to go that bit further. Did and I don't know because I don't know, but did SBF wake up, when he started FTX and go, do you know what I'm going to do? I'm going to screw everybody over. He probably didn't. Let's be fair. He probably got a little bit away from him. He probably did something and then did something else, and then all of a sudden you're in this hole that you can't get out of. So, I think the other thing there is as human beings, we then make decisions. So obviously there are some people that wake up in the morning and they do bad things because that's the way they're wired and they always intended to do that bad thing. But there are other people where they get in a hole, and I'm not excusing that. But as a human, your automatic reaction is to defend yourself. Do you know what I mean? So when he's in that situation, what's he going to do? He's going to do whatever it takes to defend himself. And if that means making the fraud effectively worse to try and do that, he's going to do that. So in a decentralized world, in a smart contract, that doesn't happen. We haven't got a human brain to make that decision. It's not about whether or not that person wants to defend themselves or not. It's about whether or not the smart contract agrees with the way the transaction is going to work. So as Tom said, do I think that we can be completely decentralized? No, I don't. I think that it needs you need executives at the top of companies in order to make decisions. I do agree with that. But I do think that computers, in a sense, or whatever, can take, or smart contracts can take away some element of human emotion from a situation.
Yeah, yeah. I actually think that could be removing human emotion from a lot of things can be a very good thing, especially for, I mean, we see a lot of customers that trade, or I should say attempt to day trade. So they read all the stories online.
Yeah.
They think they can make money. They try and they subscribe to certain influencer channels that give you strategies of how you can earn like a day trader income. But what's really going to trip you up is your human emotions, right? You're going to get greedy. You're not going to set enough aside. And funnily enough as well, that's also going to screw over your tax position if you don't plan that at the same time as well. So I do like that smart contracts kind of keep your feet to the fire. They keep feet on the ground, probably is a better word for it. Set of controls, help you invest in the market, set of constraints that only allow you to do certain things. It's a great innovation. And, one of the things that frustrates me is the whole industry is very innovative. And we have this ambition for the UK to be a crypto hub, but yet certain things, maybe from HMRC, the guidance that was released, kind of contradict that greater vision for the UK to be a crypto hub. So do you think we can get there? Do you think we can be this beacon jurisdiction that is going to be a crypto hub? Or do you think we've got a lot of work to do?
Personally, I think it's going to be a challenge for any, what's the word I'm trying to use? Like kind of like established country. So, UK, US, even places like France and, where actually we've got so much going on. We've got so many other rules and things like that contradict potentially what the benefit, if you like, of going down the kind of crypto world looks like. That I do think that actually you're potentially always going to have to look at those ones that maybe have a bit, and this is a bad example, but let's say, like, I don't know, let's take Ireland as an example, right? Let's say Ireland doesn't have as, and I'm making this up by the way, doesn't have as kind of strict rules on certain bits and pieces. They've kind of got the ability to go, do you know what? We aren't tied to all these different things over here and over here and over here. So actually we can just forge our own path and create something special. Whereas the UK, as much as we think we're independent, if the US tell us to jump, we say how high, So in reality, how much are we gonna be able to do? It is my worry, like, and that's not through want of trying, but it's just through the generic, like, where we are in the world, like, we are whereas a country that has a little bit more kind of like independence, I guess, from the global economy, maybe that has more chance of saying, do you know what, we can really adopt to this properly because we have a little bit more independence and in a way got nothing to lose. Whereas the UK, you could argue, have quite a lot to lose by upsetting their friends or their acquaintances.
Yeah, I don't know if you have any views on this as well, Tom. It seems to me there's this ambition here, and for me, like, it's just obvious that crypto is going to be this major development. Like, you look at like user adoption growth, it's like compound annual increase of like 120% year on year. Potentially 1 billion crypto users by 2030. So it's like blatantly obvious that this is going to be like a major thing. And, I've been involved in crypto for a very long time. We met with some regulators very early on in 2013, and we're still, nearly 10 years on, and there's still these like regulatory log jams. There's, let's face it, the tax needs sorting out for this. It needs simplifying dramatically. And yet there's all these other jurisdictions that are, they're taking a piece of that pie, the early infrastructure, and we've kind of lost first mover advantage. So have you got some similar frustrations?
Yeah, I mean, Joe pretty much covered everything that I would have said, to be honest. The main thing is going to very much be, as you say, having these clear regulations and policies in place which make it really easy for, the bigger corporates to follow along. Because at the end of the day, adoption is going to be the most important thing for us to become, one of the global hubs of crypto. without adoption, we're not going to get anywhere. And until these guidelines are clearer, nobody's going to want to touch it. It's as simple as that. So we need to get to that stage where clear guidelines, it's adopted, widely accepted, and then we'll get there. But yeah, as we say, it's a delicate economy at the moment. We want to make sure that we tread in the right place. And obviously, unfortunately, with all these bad events this year, it's probably not helping at all. So yeah, it's time will tell. As you say, it's dragged out for a long time. But hopefully, now that we've finally got stuff moving through Parliament, we might see the end of the tunnel in the next 5 years.
There's a lot of noise at the moment, isn't there? The signals are user adoption, but all the noise is FTX and everything.
What do you think, Dan?
What do I think? What on the UK being a crypto hub?
Yeah.
I think it all depends on leadership. I think you look at certain jurisdictions where they perhaps have a bit more autonomy in terms of political process. So, if you're somewhere like El Salvador and you're a dictator, you can decide tomorrow if you want to go on a Bitcoin standard. If you're the Sheikh of Dubai, you could decide that you want to be a crypto hub. For the UK to have the ambition to be a crypto hub, that is a democratic process. And I think there's a lack of understanding with crypto, which is kind of the main barrier as to why we haven't embraced it. I mean, we are a massive financial center, like arguably the world's largest financial center. We are a DeFi, well, not a DeFi hub, we are a fintech hub. And for me, crypto is just the next iteration of fintech. And for me, it's just passed us by in the UK, and all the top entrepreneurs that, use Recap to do their taxes, they're structuring things offshore, they're covering their arse from a regulatory perspective because they are scared of operating here because there is no clarity. So, are we hollowing out the UK in terms of this new innovative industry? I would say that we are at the moment, and the government really needs to pull the finger out if we want to retain being a world leading financial hub, because everything's going to go crypto. Like, there's just no question about it. Everything is going to have some kind of crypto rails. And yeah, we've probably missed the party, but maybe we can get some of that back because we have had some of these issues like FTX, Celsius. We're very good at being like highly regulated in like market here. So maybe we can kind of turn it around. Maybe.
Yeah, that is true. The regulatory piece is true. We do have a very good regulatory framework here in terms of so very good is extremes, but you know what I mean, in terms of the way that the framework works and the protections that it offers. We do seem to stand out in that. So you're right. Maybe we can.
And that does attract.
I just think you say it's yeah, it does. But like again, you come back to the democratic process. Like it's all very well the three of us sitting here and going, we're all from the UK. We vote for it, but the majority of people aren't in crypto. The majority of people don't care about crypto, and in fact, probably the majority of people think that it's a scam. So, actually, if you take a democratic approach, do you actually get the answer that we as crypto people want in terms of the regulation and support and whatnot? Potentially not. So that's the other problem. By taking that democratic approach.
Yeah, I completely agree. Yeah. Well, we'll see what happens. There's a round of bills to go through, right? So
certainly will.
Maybe some positive outcomes to come. And I think that if we get the DeFi call for evidence response that we want, that's going to simplify a lot of things for you guys, right? At Swapsicle and everybody that's using it. It's going to carve out all of those people from creating disposals. I've got some questions from our community. So we sent out a Slido yesterday asking, or basically saying we've got Joe and Tom on today. What questions do you want to ask them? And I've got 3 ones on here. We'll start with the first one. So we've got a customer who's staking coins, and the value of those coins have dropped 25% from their initial value. So his staking rewards have dropped in value. he's left with 25% of what they're worth. What can he do when he's filing his taxes? Because he needs to draw down some of those funds to pay his tax bill.
Do you want me to say these, Tom, or?
Yeah, go
on. Yeah, I guess in that particular case, there isn't a great deal you can do in that the income, if it was generated in a previous tax year, for example, that will still be subject to income tax at the rates that it was brought in at. So yeah, unfortunately, there isn't anything to do with that. The only thing I would say is like planning ahead. If you are generating passive income through staking or mining or anything like that, I would say plan ahead. Think about what the and I appreciate this is easy as an accountant to say. If we were talking to clients who run businesses, for example, we'd be talking to them about putting some money aside for VAT or for corporation tax or self-assessments, etc. And the same does apply here. If you're generating a passive income, even just putting 20% to one side would give you a starting point to make sure you've got something in the pot. So yeah, I would say, unfortunately, there's not a great deal you can do if the value has gone down. And you're crossing tax years as well. That's another problem. We've got a lot of people where they earned good money in the last tax year. We're now in the new tax. Well, say we're now in the new tax year, but obviously we're 6-9 months into it. But that income effectively still stands from last year. So there are things you can potentially do going forward. Like if the token then becomes, kind of negligible, you can do things like negligible value claims and things like that. But most of the reliefs are weighted towards capital gains tax as well.
Yeah.
And we're talking about income tax for staking rewards. So yeah, unfortunately not a great deal you can do. But I would just recommend trying to plan a bit and put some to one side.
Yeah, that's good advice. I mean, do you guys plan your crypto taxes? Do you use any kind of software? You don't have to say you use Recap. You can say that you use some software. But I think it's interesting that people that are heavily invested in this market, they don't have their finger on the pulse of like what is their tax position, what's their bill going to be next year. Have I set enough aside for it? There seems to be a kind of like a lot of head in the sand around this kind of stuff. And like you say, it is like running a business, especially if you're participating in, kind of like rewards-based activity, staking rewards and things.
Do you think that though is because and this is not disrespectful, by the way, in any way to anyone, but is that because people aren't business owners? Therefore they don't think about these things, and potentially their minds aren't wired that way. And actually, the biggest thing we can do as accountants, or as I would even argue people like Swapsicle is education. How do we educate people? Say for you, Dan, as a recap, how do you educate enough people, get the message, and things like this? Obviously, are one way. We do our own podcast. Shameless little plug. Nephology, if you want to find it on any podcast
Get it in there.
place. But how? Yeah, you've got to education is the key. So we mainly at the moment we use Coinly as our tax software. Obviously we're going to use you guys much more in the future, of course. But so we would always recommend that you use something like that to do it. But again, I would throw that at Tom as a taxpayer again. Did you plan? Did you have anything to aside or anything like that?
Yeah, I mean, obviously it helps a little bit. Me being an accountant, I did have some sort of grasp that I would need to tax plan. Even though tax isn't my specialty, I put money aside in the process. That's all fine. It did occur to me that I would need to register for self-assessment, but again, that might not be, apparent for most people. I had a little play with a couple of different types of software. I had a rough estimate in my mind of where my liability would sit. And that's kind of where you get to. But it is, right insane. A lot of people who have entered into crypto, a lot of people I know, especially retail traders, have never registered for self-assessment before. They don't know this arena. So yeah, education is key.
Yeah, we mentioned on the last episode that are HMRC going to have their cake and eat it as such? Because they're not really educating people that if you're on PAYE and you're on Coinbase on your lunch break, registering for self-assessment is just not on your radar. It's just not, right? All your tax is handled through PAYE.
No.
And then, you haven't filed, and, they might find some data on you, right? They might go to Coinbase every year and go, actually, this guy traded, and send you a brown letter. And then we know we've got like compliance things coming in the future, like CARF, Crypto Asset Reporting Framework, where HMRC is going to get all this information. And then they're going to come down really heavy on people and say, well, you haven't filed. But then who's educating them in the first place? I mean, yes, we can. But where's the budget from HMRC to tell people that they need to file, they need to get ready for self-assessment? I think that's missing at the moment. There's a lot of stuff on enforcement and fines, but there isn't anything on actually what you need to do.
Yeah, and look, I don't want to stick up for HMRC in any way here, by the way. But like my other argument, then we've had this conversation, Dan. I don't know, from like the last kind of call we had in terms of DeFi as well. We talked about but how much responsibility is on HMRC and how much responsibility is on the taxpayer. And I'm not saying that HMRC should do nothing. But at the same time, we talk about government spending and public funds and where that should be deployed, and should you be paying nurses pay rises, or should you be paying HMRC the money to educate that. And I think there's a huge question mark there as to to what extent should HMRC be educating, and to what extent should people like us, the private sector, how much should we be doing? And you're as a company great at it. I think we're pretty good at it. So I think that is really important as well, that we don't just rely on the public sector. We don't just rely on government funded organizations. As private companies, we do more to educate and to support and to help, which I think the likes of Recap and MYNA and Right Vigar and people like that are very good at, which is really important.
Yeah, I thought it was interesting what you just said then about like kind of like self-responsibility for these things a little bit. So there's a lot of synergies with just managing your crypto. If we look at what crypto is all about, it's about self-custody, and it's about owning your own assets. And if you think about it, most people have been used to having like a bank that looks after those for them, right? Someone else looks after your money. You don't have to think about chucking it under the mattress or whatever. And then crypto came along, and then everyone's all of a sudden got to get a hardware wallet and write down a seed phrase and go through all this painful process to have self-custody over your assets. And I think, the same is with tax, right? People that are on PAYE, it's done for you, right? It's just not on your radar, and it's a massive ball ache to do it yourself, to find an accountant, to register for self-assessment. But it's part of a process to becoming an investor. So, perhaps as people become more wealthier in crypto, they make some decent gains, then it's more on their radar. I don't know. Tom, what do you think?
I mean, my view. Sorry, Tom. Like my view is very much like about personal responsibility. My view is, people we've got a blame culture. We all want to blame everybody else. If you haven't got any money because your crypto's gone down, you're going to blame HMRC for not applying a slightly different rule. And like I said, I'm not a fan of a lot of these rules. I'm not a fan of sometimes the way HMRC operate and things like that. But I am a fan of personal responsibility, and people have to take responsibility for their actions. And it's too easy to blame other people. And like you say, crypto is built on self-custody. Crypto is built on not relying on anybody else. Yet crypto people then want to rely on somebody else to fix a problem that they might have created. So, that's probably going to piss a few people off that listen to this, if I'm honest. But it's a fact. Like, we've got to take an element of responsibility. Tom said earlier, he's an accountant. Okay, so he's got a slight head start, but he's a taxpayer at the same time as well, and he took some action. So I just think personal responsibility is key. Anyway, sorry, Tom, for jumping in, taking over.
No, I mean, obviously with most people that are investing in crypto, most of them are going to use an app like CoinMarketCap, for example. Everybody's going to be tracking their positions. Everybody wants to know where they're at. And obviously when they're recording these gains and losses, you're tracking them for a reason. To be honest, I don't know many people who are just investing in crypto and just, leaving it there. Most people are tracking and updating it. So the data and information is there for people to use. These exchanges have the capabilities to export your, Excel spreadsheets for these reasons. And yeah, as you say, as Joe said, it's about self-responsibility. You're doing all of this for a reason. You have the ability to track all these things, and you've got to use it for something, and that is your taxes. So yeah, it is very much down to just taking a step back, and just thinking about the wider environment that you're, participating in.
Yeah, we kind of said on the first podcast that I like sleeping, right? And I don't like brown letters on my doorstep. So, that's quite a good motivation to getting your taxes sorted, right? And there's some positives. If you get on top of all this, you can understand your tax position. It allows you to plan. And we got into a discussion around if you really are long crypto and you're looking at planning, you could look at things like SaaS pensions, like maybe incorporating a business, but you're not going to know if you need to do all of that unless you're doing your accounts. So, something like Recap or other crypto tax software, you can get all that in, you can get that understanding, and you can then make those decisions. And it could be pretty hands off once you've kind of got everything up to date. But unless people do that, you literally are kind of like playing around in the dark. You're not going to know what your tax bill is. And then you're going to be asking questions like, my assets have gone down in value and I've got no money to pay my bill. So like Joe said, it's planning. It all comes down to planning. Cool. Should we go on to the next question? This is a really good DeFi one, by the way. So this user is asking, I would like to purchase a car by borrowing DAI on the decentralized Oasis platform with my Ethereum as collateral. Is this a tax-free transaction?
Well, the short answer is, based on the guidance, the short answer is no. But, again, having said what we said earlier about terms and conditions, there's another argument to say, if you can read through terms and conditions, I haven't looked at them for Oasis, for example, but, if you were to read through terms and conditions and find an element of that clarifies that there is no beneficial ownership change when you collateralize that loan, then potentially you could look at that as not being a taxable transaction. But per the guidance, a collateralized loan, putting collateral down, is deemed a transfer of beneficial ownership, and therefore that Ethereum that you put as collateral will be a taxable disposal.
Yeah, I'm on a similar viewpoint. I think you could argue it if you really wanted to, but it's kind of like medium to high risk, right? And this is really frustrating for me because...
And I'm not saying that it's right.
Yeah. This is kind of really frustrating for me because like a year ago, there was like the whole kind of like all the influencers on Twitter, throw your collateral down, take out a loan, don't create taxable events. And a lot of that was coming from US influencers that have a very different tax system to here. And then we got the DeFi lending and staking clarity in February. And yeah, lo and behold, if you had done all of this stuff, you're going to be in quite a tricky situation. Sorry, Tom, you were going to say something.
No, I agree.
No, I didn't have much more to add there, to be honest. I was just going to say, obviously, there's obviously the interest implications and stuff as well you've got to consider in that case. But yeah, other than that, yeah, it's a disposal.
So how will it change if we get through our DeFi lending and staking call for evidence responses? How do you think it will change, Joe?
Yeah, it's a good question. I'd have to remind myself of some of the bits and pieces that we put in there. But from my perspective, it's all about I guess, and it's funny actually, if we talk about this internally in the office around a difference sometimes between accounting for businesses and tax for individuals or what have you. And in accounting, there's a lot more substance over form. What are you doing it doesn't really matter what the concept is. It's actually what are you physically doing. Let's look at that, and then let's account for that based on what you're doing, right? And whereas tax, it does seem a lot more like, this is the rule, this is what we say. It doesn't matter what you were intending, because that's the rule and that's what you have to do. So I think there's an element of that could be brought in, of like, what is the intention here? When I collateralize a loan, do I believe that I'm giving up ownership of that asset? And am I intending that part of the project? Now, I'm not saying this is exactly what we said, by the way, but that is one thing that I think is really important, is having that element of what are you trying to do, what are you trying to achieve, and I think that and this is an argument that I've had pushed back at me on many times that I've said it, but when I get a mortgage and I put my house up as collateral effectively to borrow that money, I don't dispose of my house. The bank doesn't own my house. The bank has a charge on that property in that if I don't repay my debt, they have the ability to call that debt in, right? So there's an agreement that says that I will give them my house, or I won't give them my house. They'll take my house if I don't pay my mortgage, because there has to be protection for the for the bank that's lending the money. But that doesn't mean the beneficial ownership is necessarily changed. So should it be the same in crypto? Should it be that actually the ability to take back the collateral if not repaid is there? And obviously at that point, there's a change of beneficial ownership. Or should we have the route where we've got at the moment, where it's a change at the point of transfer? I think it should be the opposite. I think it should be what I just, the example I just gave. So again, the reason why people bat that back is they say that, crypto is different. And I think, I don't know about you, Dan, right? But when I say something that I think is fairly sensible, people say, yeah, but crypto is different. We can't treat it that way. It's different. But then when you say, well, hang on a second, the rules that you're using are the same rules that you apply to other asset classes. So for 1 minute you want it to be different, and the next minute you kind of treat it the same. So I think a bit of clarity on that is important, to be honest.
Yeah. It's interesting that you say that around crypto is different. I mean, it is a very different asset to anything that we've ever seen before, right? This is an asset that you can own outright, that isn't defined in law as like a particular type of asset class. Like the Law Commission have said, there's kind of work required to kind of get crypto into English and Wales law. So we're kind of dealing with this like nuanced asset that we've never seen before. We're trying to like apply existing rules to existing assets to something that is so nuanced. And I think sometimes we do pick and choose that, it'd be great to include it under that. And then another time it's like, no, it's completely different. We need something else for it. And I think what it needs is, and again, the Law Commission are on top of this. Like if you get it defined in law as its own particular type of property, then you can kind of rip up the rule book a little bit and define your own kind of rules around it. You can define particular taxation on it as well. And before that happens, anything that we do with, the legal system or even HMRC rules around crypto assets, it's all just going to be kind of teetering around the edges until we can actually define it in English and Wales law.
I guess the issue though with that is that's a whole different ballgame, right?
Yeah.
What we're doing at the moment is trying to, I say what we're doing, what HMRC are trying to do at the moment is say, look, we want to give a little, in their eyes, they want to give clarity. I think some of us would argue that they've done the opposite, but what they're trying to do is give clarity. And I guess they would say, look, for us to get a whole new rule basis through, as an asset class is going to take years, and we're trying to give taxpayers that clarity now. But you're right though. I was going to point out earlier actually, and I forgot, and then you just made a good point that the Law Commission are a great example of an organisation that are trying to understand and trying to work on how can they change things, how can they improve it. So I think that's they're a great example of it. I mean, we haven't seen any actual proof of the pudding yet, but the theory's there.
Yeah. I read that Law Commission report in July, and I was just like, they just get it. They get that this is like such a disruptive technology, and that the benefits to the economy are going to be insane. And the fact that they actually want to define crypto assets in law, and they want like the UK to be like a major jurisdiction where it is defined in the legal system, like kind of feeds into that crypto hub narrative, right? But it's how quickly can we get there? It just seems that things take forever, and by which point we've lost our competitive advantage. Cool. I mean, Tom, are you thinking of collateralizing some of your pop tokens to buy a car?
No.
Take quite a lot of pops, Tom.
Yeah, no, probably not right now. I mean, obviously, I'd be very surprised if anybody was up on their tokens right now. So I wouldn't be wanting to dispose at the moment.
It's the dream, though, right? Maybe it isn't a disposal in a couple of years' time, and you're not creating taxable events, and you get yourself a nice new car.
Yeah, very.
Cool. So I've got one more question from our community. It's around low liquidity coins. So basically, they're saying that they have some low liquidity coins coming in as staking rewards, and they're trying to value those in GBP, and they believe that that's kind of inflating the tax that they need to pay. And they're asking, how best can I adjust the value of my staking rewards? I suppose the question is there, can you actually adjust the value of them? You got any thoughts on this, Joe?
I was going to ask Tom to answer this first, but...
Go on, Tom.
Yeah, go on, Tom. What do you think from a DeFi perspective?
Well, obviously the issue with low liquidity coins is obviously it's incredibly hard to depict the market value because of how much you're going to get slipped. Obviously, the lower the market value, the higher the slippage percentage is going to be. So while, on paper, you're going to have $1,000 worth of this token, if the liquidity is only $500, you're not going to get $1,000 for that token. You are going to get a significantly lower amount when you sell it onto the open market. So yeah, it is quite it's a tricky one in terms of the valuation when it comes to low liquidity coins, because obviously that $1,000 on paper, you don't realistically want to use that if that's not what you're going to get back for it. So yeah, I guess it all just comes down to are you going to take the rate that you're going to take from selling onto the market, or are you going to take what's on paper? Probably both are incorrect. So how do you find that happy medium?
Yeah, tricky one, isn't it? I mean, valuations can really screw you over. Where do you get the valuations from? How do you make sure it's consistent? How does it stand up to HMRC? You kind of got all these questions. There's no black and white answer, really, is there? It's kind of like just kind of do your best and try and justify it, override it yourself maybe and justify it.
Yeah, I think ultimately as well, a lot of this stuff, we're talking personal tax here, so we're talking, self-assessment, right? So we're talking, it is what it says on the tin. It is a self-assessment of your tax position. And if HMRC disagree with you, then my argument would be, as long as you've got, sufficient evidence to back up the reasons that you've done what you've done, then in principle, you're in a fairly good spot. I think, and there is software out there. There's a company called Lukka, Lukka. I don't know if you've come across them, Dan, but they're really good guys. I do quite a lot with them, and they have their, and don't get me wrong, this isn't for all tokens out there, but they have their kind of Lukka fair value kind of methodology where they basically kind of, and I won't do this justice, by the way, but they basically go out to all these different pricing markets and pull together what they would argue is a fair value for that token, because as we all know, right, if I try and buy Bitcoin on Binance, I potentially am going to get a different price now, albeit very, very slight given the liquidity of Bitcoin on KuCoin as I will on Binance, for example, right? So even at that level, there is the chance of a different, different price. I remember a couple of weeks ago, I was trying to swap USDT for Ethereum on KuCoin, and it took me ages to get the order to go through, just because it was like the prices kept changing. Whereas I did it on Binance and it happened straight away because the liquidity is obviously significantly higher, that it just matched off straight away and went out the door. So yeah, I think that's a way to do it, is to get a fair value methodology. And we talked before we came on air. One client I was working with, we looked at their price of their token, and then we basically said if they were to sell, we went on the DEX that it was available to trade, and we typed in, say, I can't remember exactly what it was, but say 1 million, of the token. If they were to sell 1 million of the token, what would the slippage be? And the slippage was 98%. So there's an argument in that point to say, well, actually, there's zero value pretty much in that token, because if I try, or in the holding that I've got of that token, because if I try and sell all 1 million, I'm never going to be able to, generate, the funds to cover anything. So what are 1 million tokens worth? But then the other argument to that is, if you had 5, you tried to sell 5, you probably get, like, say, a 1 or 2% slippage. All of a sudden, you're now going, are those 5 worth $1, but the 1 million are worth nothing? But then you can't have, it's a really tough, like, we can't have one taxpayer that says, I've got 1 million, therefore it's worth nothing, and one taxpayer that's got 5, and they go, oh, well, that's worth $1, so there's $5 there. So it is really, really, really tough. So I think it's going to be a hard one to argue, but if you feel like you've got a methodology of working it out, or you want to maybe spend the time of, on the day of you receiving those tokens, what the prices were on all these different exchanges that you could get it on, maybe that's a route. But again, if you're using software done like Recap, for example, you guys are going to have to pull data from, sources such as CoinMarketCap and places like that. So then you're going to have to override prices in the system, and so it's a challenging one, definitely.
Yeah. Similar to Luca, we use a company called Nomics for our fair market valuations. So they pull like all the top exchanges, and they try and remove some of the exchanges that maybe are not as legitimate, to try and come up with a fairer fair market value. Liquidity is a factor in that as well. I think this question's like a really challenging one, and we've been into the weeds of this a little bit at Crypto UK, Joe. And it's like, well, what happens if you've got like pop tokens on, say they're on Avalanche, but then you've also got pop tokens on another blockchain, and you've got 2 DEXs on each blockchain. Do you use a fair market valuation across both blockchains? Do you just pick one? The similar kind of argument if you're trading Bitcoin. Do you use, you're trading it on Kraken. Do you need a value from Kraken, or can you use a global market value? There's no guidance on that. It's just what is consistent, what's fair, and maybe just stick to like one methodology.
Yeah.
What do you think?
I don't really have an answer for you. It's a tough one. Yeah, Tom, what do you think?
Yeah.
Go on, Tom, you have the difficult question.
Oh, I was just going to say, arbitrage opportunities are always going to exist. You're never going to get an exact price match across multiple different markets on multiple different chains. That's why these arbitrage bots and stuff exist, and people make a fortune off of it. But it is a very tricky one to get that baseline valuation. And like you say, it's not an easy question to answer at all, but there will be certain methodology to use.
Yeah, sure. Cool. Well, we've been through some community questions, and I think we've kind of talked around DeFi enough. Hopefully, we're going to get some clarity from HMRC of what's going to change in the months ahead, and maybe some of these pain points are going to disappear at some point in the future. But we're going to wrap it up now. Thank you very much for your time on this, Joe and Tom, and I look forward to seeing you all on the next episode of Crypto Tax Sucks. Cheers.